Okay, let's continue with this now. I think we have just few more questions to discuss, maybe another 40 minutes kind of a discussion and we should be done for today. Let's come to question 12. You are required to compute WACC of Ganpati Limited considering of given data using book value weights as well as market value weights. You will understand the importance of the point which I was saying earlier. Capital structure is as under, market prices are as under, additional information. 100 per debenture redeemable at par, 10% coupon rate, 4% flotation cost, 10-year maturity. 100 per preference share redeemable at par, 5% coupon, 2% flotation, 10-year maturity. Equity share, firm has a practice of paying all earnings in the form of dividend, corporate tax rate. So some data is there in the question. Now, I am required to calculate a WACC. For that, the first step is calculating cost of individual components of capital. When you do cost of individual components of capital, don't look at this information. Don't look at this information. This will unnecessarily try to complicate things for you. This information is not going to help me in calculating cost of individual components of capital. When I do cost of individual components of capital, my first preference will be issue price minus flotation cost. That is there in this question. This question is talking about some flotation cost, some coupon rate, some issues being made. If this data was not there, then you could have taken this as net proceeds. You could have taken this as net proceeds. So there is information in the question to calculate net proceeds, which is issue price minus flotation cost. If that data is not there, my net proceeds is equal to current market price. Then what is the use of this data? This data will be useful to calculate market value, because you are required to do book value as well as market value approach. Both have been asked in WACC. Book value weights as well as market value weights have been asked. So if I look at this, cost of debenture is equal to 100 per debenture redeemable at par, 10% coupon rate, 4% flotation cost, 10-year maturity. So 5 rupees interest after tax, 100 is the redeemable value, 96 is the net proceeds. Issue price, assumption is issued at par. Flotation cost of 4 divided by 10 years by 100 plus 96 by 2. 100 plus 96 by 2. This will give me the cost of debt. This will give me the cost of debenture. How much is the cost of debenture? How much is the cost of debenture? 5 point. If you use this 105, no, your net proceeds will be altogether different. If you use this 105, the net proceeds will altogether be different. I would have used 105 as net proceeds if that below information was missing in the question. The below information was missing in the question, which said 100 per debenture redeemable. If nothing is mentioned about new issue, I will have to take existing issue and proceed ahead. Wherever there is data for a new issue, my first preference will be new issue information, which is issue price minus flotation cost. Cost of preference is 5 rupees, 100 minus 98. 100 per preference share redeemable at par, 5% coupon rate, 2% flotation cost, 10-year maturity. 100 minus 98 by 10 plus 100 plus 98 by 2. 100 plus 98 by 2, how much is this? 5.25%. And last is cost of equity, which is 4 rupees flotation cost, market price of 24. I will have to give preference to a new issue being made. So the dividend is 1 rupee divided by 24 minus 4 plus 5% of growth rate. Plus 5% of growth rate, how much is this? 1 by 24 minus 4 plus 5% is, I think, 10%, 5% plus 5%. See, if you are getting confused with percentage, then write 0.05 plus 0.05, because 5% plus 5% is not 5.5, either write it as 0.05 plus 0.05, because somewhere some students do make that mistake. So write it in decimals and then finally convert into percentage. I am not getting into the WACC part of it, which is just a multiplication job. This was the critical part. You have your book value weights, you have your market value weights, and then sum of product by sum of weights. I have not used the market value information for my step 1, and which is what we don't do for most of the question. I don't use that data for most of the question. Let's come to question 13. Navya Corporation has a capital structure of 40% debt, 60% equity, Company is presently considering several proposals costing less than 20 lakh. Corporation always raises the required funds without disturbing the debt equity ratio. Project cost up to 2 lakh, above 2 lakh and up to 5 lakh, above 5 lakh and up to 10 lakh, above 10 lakh and up to 20 lakh. Assume the tax rate. Cost of capital of two projects X and Y whose fund requirements are 6.5 lakhs and 14 lakhs respectively. If project is expected to give a return of 10%, determine under what condition it would be acceptable. Go through the question. Quickly go through this. Okay, now my WACC can also change based on the amount of capital I am raising. If I ask somebody a 2 lakh loan, he may give me at a lower rate of interest. But if I ask for a 20 lakh loan, he may increase the rate of interest. The reason is simple. 2 lakh loan, I have the ability to repay. 20 lakh loan, maybe he doubts my ability to repay because my income has to go up significantly if I have to repay a higher amount of loan. So if the amount goes up, we may see this interest rates going up, which is what is happening. 10 becoming 11, 11 becoming 12, 12 becoming 13. I have a project which is 6.5 lakh. 6.5 lakh means this is the cost. 12% for debt, 14% for equity. Our debt equity mix is 40:60. So for a project which is 6.5 lakh, the cost of capital is 12% into 40 plus 14% into 60, 40-60 mix. Another thing you have to take is this before tax or after tax? That's an assumption. That's an assumption. I will take that to be before tax. I'll take that to be before tax. If you take that to be before tax, you'll have to do 12 into 1 minus tax rate. See, instead of doing source, cost, weight, product in a detailed format, cost of debt is 12 into 1 minus tax rate 5%. Weight of debt is 40%. Cost of equity is 14%. Weight of equity is 60%. 5 into 40% plus 14 into 60% is the cost of capital if you are doing a project worth 6.5 lakh. If you are doing a project worth 6.5 lakh, 5% into 40 plus 14% into 60. If you are doing a project worth 14 lakhs, if you are doing a project worth 14 lakh, cost of debt is 13 into 1 minus tax rate, cost of equity is 14.5. 10.8% and 11.3%. 10.8 and 11.3 are the two cost of capital if you are planning to do a project worth 6.5 lakh and 14 lakh. As you increase the quantum of the project, the cost of capital goes up. The reason for that is people believe it is more riskier. Now the question says the company can earn a return of only how much? 10%. I will accept a project if the cost of capital is also lesser than 10%. The cost of capital has to be lesser than 10%. If you can earn a return of 10%, I can do the project if the cost of capital is lesser than 10%. Simple logic. Cost of capital should also be lesser than 10% because you are able to earn only 10%. So cost of capital, if it is lesser than 10%, I go ahead with such project. I go ahead with such project. For that, you may have to do a weighted average calculation of this as well as this and see which of the scenario the cost of capital is lesser than 10%. If I don't think so, I can do a project of 10.8, 11.3. These two projects I don't think so I can do because these cost is more than 10%. If your cost is lesser than 10%, I think which is 2 lakh worth of a project and 2 to 5 lakh worth of a project, these two projects I can take it up. These two projects I can take it up because the cost of capital is lesser than 10%. 14 is something you can manage it. Okay, go through 15. I think this has come so many times in exam as well. Frequently tested area, RTP, MTP exams. Nothing much is there in the question, but because of it being tested so many times, okay, this is a question on WMCC, weighted marginal cost of capital, some fresh money the company plans to raise. It wants to raise an additional capital of 10 lakh. It has 3 lakh in the form of retained earnings. Following are the further data. Debt equity mix is 40-60. In that, up to 1 lakh 80 has a different tax rate. Above 1 lakh 80 has a different tax rate. First, they want us to find out what is the pattern for raising the additional finance, what is the post-tax cost of debt, what is cost of retained earnings, cost of equity, and finally cost of capital, which is technically weighted marginal cost of capital. Now, pattern of raising additional finance, I need 10 lakh. We need 10 lakhs. We have done this in one of the earlier question. What's the broad breakup? Debt how much, equity how much? Debt is 4 lakhs, equity is 6 lakhs. In the debt side, I have further breakup. There are two types of borrowing. One is 10% debt, which is 1 lakh 80,000, and there's another 16% debt, which is 2 lakh 20. 10% debt 1 lakh 80 and 16% debt is 2 lakh 20. And this is retained earnings, external equity, retained earnings and external equity. Retained earnings is somewhere the first line of the question mentioned how much retained earnings is there? 3 lakhs. External equity is 3 lakh. This is one part of the question. This is one part of the question. The second part of the question, what is the average post-tax cost? There are two costs. They want an average of that. Average post-tax, weighted average. Technically it is weighted average. Now listen, cost of debt is 5% and 8%. Why 5%? 50% is the tax rate. There's a tax rate of 50%. So 5% and 8% is the cost of debt. I don't need one number. I don't need two numbers. I need only one number. Average cost they wanted. What is the post-tax average cost of additional debt? What we have understood is we are going to take this 1 lakh 80 and this is 2 lakh 20. 1 lakh 80 is 5% and 2 lakh 20 is 8%. So average cost is 5 into 1 lakh 80, 8 into 2 lakh 20, whole divided by 4 lakhs. This is weighted average. 5 into 1 lakh 80 and 8 into 2 lakh 20, whole divided by 4 lakhs. Whole, how much? 6 point? No, it will not be 6. It's a percentage, no? Okay, 6.65%. Okay, 6.65%. 5 into 1 lakh 80 plus 8 into 2 lakh 20 divided by 4 lakh. Divided by 4 lakhs. Cost of retained earnings and cost of equity. There's no data on flotation cost in the question. There's no data on personal tax. Both are going to be same. Which is cost of equity is equal to 2 rupees. Dividend payout of 2. Current market price is 44. I'm adding 10% on top of this. I'm assuming this to be D0, okay? I'm assuming this to be D0. Your wish, you want to take it as D1, I don't have a problem. I'm taking it to be D0, 2 plus 10% by 44 plus 10%. 15% is the cost of equity. 15% is the cost of equity as well as cost of retained earnings. Both are same. Cost of equity as well as cost of retained earnings, both will turn out to be 15%. And then finally we put it in the format. Debt is at 6.65. Equity is at 15. Retained earnings is also at 15. This I think we had 4 lakhs, 3 lakhs, 3 lakhs. So I think this will be 11.66%. 11.66%, 1,16,600. Any doubts on this? We have taken debt, you can write as two separate line item also, 5% debt and 8% debt. We have taken it together and made it as 6.65. Because that was one of the specific requirement of the question, average cost of additional debt. Okay, let's come to question 16. It is similar to one of the question we did earlier, but there's only one change I think there. Compute WACC by using market value weights, debenture, preference share, equity share, market price of these securities, additional information, 100 per debenture, redeemable at par, 10% coupon rate, 2% flotation cost, 10-year maturity, all that is fine. What question said is, you are required to use YTM method to calculate cost of debenture and preference share. YTM method is your IRR method. We are required to calculate YTM method to do this calculation. Now, when we did that previous question, if you remember what we had done, we used to calculate in that shortcut method. So I use the shortcut method and I'll get an answer. I'll use the shortcut method and get the answer. We had assumed this is an assumption based solution. Okay. If you remember this question, this is the question I was talking about. In this question, we had taken issue price to be 100 and flotation cost was 4%, and we did that calculation, whatever we had to do. We had taken all the issues to happen at par. One of the problem I had said I'll take the issue price to be 98, ICA answer was at 100. That's an assumption based answer. I think this question, they have assumed, okay, it's not that I'm using this information will mostly not be used for calculating cost of individual components of capital. The only thing is they have assumed issue price to be equal to this number. They've assumed the issue price to be equal to this number. That's an assumption based solution. I cannot tell you exactly when to do this, when not to do this, because I have a exactly same question sometime back we had done where the issue price was taken as 100. Here the issue price in ICA solution is taken as current market price minus flotation cost. Basically the issue price is taken as current market price. Net proceeds is equal to issue price minus flotation cost only. It is not net proceeds is equal to current market price. Net proceeds always the first preference is given to issue price minus flotation cost. The only thing which is done here is you have assumed this to be issue price minus flotation cost. You have assumed this to be the issue price. This is an assumption. This is an assumption based solution. The assumption is issue price is equal to current market price. The assumption is issue price is equal to current market price. Let me do this because one of you have told me to do a YTM solution. So let's do this quickly. Let's first take the basic information. Interest is, in this question, the interest is 100 per debenture, redeemable at par, 10% coupon rate, the tax rate is 30%. So interest is 7 rupees after tax. Then you have interest after tax, redeemable value. Redeemable value is 100. Redeemable value is 100. Net proceeds is issue price minus flotation cost. The only assumption I am taking at this stage is my issue price is assumed as equal to current market price. I did take that assumption in one of the question where the solution was different. 115 minus 2%. Can you tell me how much is this? 115 minus 2%. Life is 10 year. I want you to do the shortcut method and tell me the answer. First do the shortcut method in your calculator. Shortcut method is interest after tax plus average other cost by average funds employed. Do that and tell me the answer. Shortcut method. How much? Whatever. So you have to do that calculation. You get exactly the same. Well, even if you make a mistake at this stage, I will not be bothered. It won't be 7 point. It will be lesser because your net proceeds average other cost is negative in this case. 5.38. Okay, if you have got 5.38, I need an IRR calculation. I'll take the starting rate to be 5%. I'll take the starting rate to be 5% because I need an initial guess rate to start with IRR calculation. So, for doing IRR calculation, year cash flow PVF at 5%, DCF, PVF at 5% and DCF, year 0, 1 to 10 years is an annuity, and at the end of 10th year, you will get back the principal. Year 0, 1 to 10 and year 10. Year 0, 1 to 10 and year 10. Year 0, I'm going to write minus 112.70. Minus 112.70. I can write plus 112 also. The company is going to receive this amount, but I'll write it as minus 112 so that I get a positive NPV. I increase the rate. I get a negative NPV. I reduce the rate. Every year you will get 7 rupees, and at the end of 7th year you will get 100 rupees. At the end of 7th year you will get 100 rupees. This now needs to be discounted at 5% now. $7.722, 0.614, and this can give me a positive NPV as well it can give me a negative NPV. Anything can it turn out to be. I've done 5%, I get a positive NPV of 2.754. I can increase it to 6, I can increase it to 7 also. If I increase it to 7, high probability I'll get a negative NPV. If I increase to 6, maybe again I may get a positive NPV. So I'll increase it to 7. PVF at 7% and DCF. I'll not get into IRR calculation and all. That is something we maybe discuss it once I go to your investment decision chapter. One positive, one negative, somewhere in between your YTM will be there. Yield to maturity. YTM is basically yield to maturity. Technically calculation as per IRR method. Technically calculation as per IRR method. I think the final answer will be more or less closer to your initial answer. You got an initial answer of 5.7 some percentage. I think the final answer is, we did 5%, 7%. The final answer is 5.36. The final answer is 5.36, which is almost same as the initial answer. You had done an initial answer. That's why I said do that initial answer in the calculator and then start doing it. Now the only difference is this question and the earlier question is here I've assumed issue price to be equal to current market price. Is there a logic for that? I cannot explain a logic because that question and this question, the words are exactly same. The words are exactly same. That question we said issue price is equal to 100 rupees. This question we have said issue price is equal to current market price. The same thing you will continue for preference also, okay, which is current market price minus, you will get the answer under shortcut method and then follow it up under the IRR method. Clear? Any doubts on this? I'm not discussing beyond this because everything else is same. Everything else is same. Just that the only difference here is one, you have to do YTM approach. Second, they've assumed issue price to be equal to current market price. They've assumed issue price to be equal to current market price. Both question exact same wordings. There's no difference between the wording of that question and this question. But one place we took it as current market price. One place we have taken it to be the face par value. That's purely an assumption. Okay, come to 17. I'll focus more on calculating cost of individual components. Come to 17. Go through this. I think One tricky part is going to be debenture. Balance is fairly simple. I want you to calculate cost of individual components. Debenture alone can be slightly tricky. Okay, in fact, I'll take you through this. Go through the question first. Go through the question. Even equity can have some bit of confusion. Go through the question. Okay, this question has 4 types of capital. One is equity share, retained earnings, preference, debenture. Book values are given, market values are given. You just need to do multiplication and get to the answer. That is calculation of WACC part. When you do market value, this 2 crore will have to be split in this ratio, 120:30. That is the rule. Your market value of equity will have to be split in the ratio of equity shares and retained earnings, because we don't give a separate value. Now I have few issues in this question. 1. During the previous 5 years, dividends have increased from 10.60 to 14.19. Dividend at the end of the current year is expected to be 15. First in the calculator, 15 minus 14.19 divided by 14.19. Can you tell me what percentage is this? Okay, let me take it as 6% for the time being. Okay, in the calculator, start with 10.6 and keep adding 6% for 5 years and see what number you get. Yeah, 10.6 is the starting part. Add 6% for 5 years, plus 6%, plus 6%. 14. So the growth rate is 6%. The growth rate is 6%. They have not given the growth rate directly in the question. 15 minus 14.19 divided by 14.19. In fact, this should not have been 15 in fact. Can you tell me 14.19 plus 6% is how much? 14.19 plus 6% is how much? So this should have been 15.04, but they gave it as 15. I can't do much about it. 15 minus 14.19, I did the calculation. I got 5.7. I've rounded off to 6 and checked in the calculator, starting with 10.6. If you check in plus 6%, you keep doing, and if you don't get 14.19, you get a number higher or lower, then keep adding 5%. Somewhere closer the growth rate is going to be. Either it is 6% or 5% or maybe 5.5%. Some closer growth rate it will be. So the growth rate in this question is 6%. The growth rate in this question is 6%. So K is equal to D1 by P0 minus F plus growth rate. D1 is 15 rupees. Assumption is this is the next year dividend. Assumption is this is the distant dividend. Issue price is 125. Flotation cost is 5 rupees. Growth rate is 6%. So the point is that 5.7 is not the past growth rate, no, 10.6 to 14.19. That's why I told you to do the check. From 10.6 to 14.19, when you did the check, let's say in a practical world, what will happen is, if I have this number, 10.6, 14.19, this divided by this, I can do power 1 by 5 and all in Excel. Technically, you will have to do that, which is not possible for you to do in your calculator. The answer is 6.01%. Exact number is 6.01. I wouldn't even tell you to do 15 minus 14.19. Nothing needs to be done. I have the number 14.19 divided by 10.6 power 1 by 5. Basically, I am trying to take a square root, another square root. It is 1 by 5. If it is 1 by 4, I would have told you to do a square root. But it's 1 by 5, which is not possible for you to do in calculator. So that number turns out to be 6%. Issue price is 125. So P0 minus F. Issue price is 125. Between 130 and 125, 125 would be preferred. Between 130 and 125, 125 is going to be preferred, because our first preference is always to issue price. The second preference is to the current market price. So 125 minus 5, When you do retained earnings, just don't subtract this 5. Leave this 5 to be subtracted. If you look at this 1 plus r power 5, in calculator you cannot do that. That's the issue. I can do this in Excel. I did power 1 by 5 to get that answer, which is not possible for you to do in this. So this is fine. Your retained earnings, you are not subtracting that 5. Another important issue is preference capital is also fine. 15% preference share with face value of 100 would realize 105. No information on the life of the instrument. So 15 rupees is the dividend. Net proceeds is 105. They have mentioned net proceeds to be 105. The other problem is with debenture. The company proposes to issue 11-year 15% debenture. 11-year 15% debenture, but the yield on similar maturity and risk classes 16%. Listen, I normally say if you don't have the issue price, issue at par and all, you assume that is fine. This question, that logic is not going to work out. What they are saying is, company is planning to issue a 11-year debenture. The company is planning to issue a 11-year debenture, paying what interest? 15% debenture. What others are doing is they are paying 16%. See, the rule in the finances, whenever you issue any security, if it meets expectation of the investor, what is people expectation is 16%. If you meet that expectation, you can issue at par. If you meet the expectation of people, you can issue at par. We are giving 15%. People are expecting how much? 16%. People would want this to be issued at a discount. People would want this to be issued at a discount because you are not meeting the expectation of the people. Ignoring the taxation aside, cost of debt is equal to interest by net proceeds, or technically let me call it as current market price for the time being. This is a formula which you learn at CF final. This is basically on current yield. This formula is technically called as current yield. Cost of debt is equal to interest by current market price. What is that the company wants to pay? How much they are planning to pay? 15. I'm assuming face value to be 100, okay? So company will pay 15 rupees. Company will pay 15 rupees. People want 16%. People want 16%. Company is paying only 15%. So the issue price can technically be 15 by 16%. You will have to issue at a lower price. You will have to issue it at a lower price. The issue price is you are paying only 15 rupees. People are saying give me 16%. What is this price coming out to be? In a scenario, if both were 16, both were 16, you are paying what investor wants, he will give you 100 rupees. He will give you 100 rupees. In a scenario, you pay more than 16. If you are paying 18, people want 16%. So 18 by 16%, you will get an answer. So here 15 by 16% is 93.75. Clear? Any doubts on this? So beyond that, there's nothing much there. The issue price of the debenture will be 93.75. The issue price of the debenture will be 93.75. There's a flotation cost of 2%, your wish. You can take 2% of face value. You can also take 2% of issue price. You can take 2% of face value or 2% of issue price. I'm assuming the face value to be 100 in all my calculation, okay? So you see here the computation would have been presented. 93.75. The company is not meeting the expectation of the investor. The issue will happen at 93. My flotation cost 2% on face value is the ideal assumption here. That's the assumption taken here. Just give me a minute. There's no much additional questions in this area, so I think broadly we are done with this. So we have covered 3 areas today. Balance areas I'll start tomorrow. Will start at 9:30 itself. Tomorrow class will start at 9:30. Should go on till I think 4:30. That's the timing I'll keep for tomorrow. Okay, we'll end with this.